Hey, welcome back. My name is James Johnson, and my expertise lies in retirement and estate planning. And what I want to talk to you today about is probably one of your favorite subjects, and that's your 401k or your qualified plan. And we're going to talk about the 401k tax bomb. Where do I get 401k tax bomb? I used to be a master lead advisor for Ed Slott, and Ed called himself a recovering accountant, and they always was referring to the tax bomb inside of your qualified accounts. And I hope you get this today, because right now today, taxes are on sale, and this is a really good time to start putting this to use inside of your life. So what does it really mean when it comes to taxes in our 401k? And what it really means is that we're deferring the taxes, but more importantly, we're deferring the calculation out to a point in time where we really have no idea what that rate looks like. So to give you a really good description of how that works, I use this quite frequently in seminars I do. I'm going to write you a check here. I'm going to cut you a check right now. I'm going to loan you some money, okay? I got $100,000 here made out to you, okay? So I'm going to loan you $100,000. Now, if I was going to loan you $100,000 right now, you'd have some questions for me. And those two questions that you would want to know is, you'd want to know, when do you have to pay this back? And what rate do you have to pay it back at? Now, if that was the two questions you want to know, my answer to you would be, well, look, I don't really need this money right now, so I'll tell you what, when it comes time to pay me back, I'll let you know. And if that was the choice, would you actually do that? And I've yet to hear a person say, yeah, well, I'm good with that. And then the second question you would want to know is, what rate do you have to pay it back at? And I would tell you, well, interest rates kind of suck right now. So here's the deal. When it comes time to pay me back, I'll let you know what the rate is. And of course, you would never enter into an agreement where you didn't know when you had to pay it back and what interest rate you were going to have to pay it back at. Yet I submit to you that your IRAs, your 401ks, your 403bs, your 457s, your defined benefit plan, anything that's tax deferred, you are doing exactly that. You're putting money inside of an account that your business partner, Uncle Sam, gets to determine when you pay it back, and he can change the rules anytime he wants. And in addition to that, he gets to determine what rate you have to pay it back, because once again, he can change the rules anytime he wants. So let's talk about that. Let's talk about the pros and the cons about how that works. Now, the pros to any 401k or 403b or 457 is that we're going to have company matching. Now, in addition to that, in most cases, they're legally, federally protected. We have high contribution limits. Those limits are around $26,000 right now. And for most people, the biggest thing that a 401k or any one of these ERISA plans does for them is it forces them to save. Because we had something called the Pension Protection Act, and that did away with pensions. So for those of us that no longer get pensions, it's all about what we save. Now remember, going towards retirement, in order to retire, you got to have one thing, and that's a paycheck. And for most people, that paycheck's going to be built right around these assets that we saved up. So our pros are all of those things. So what are our cons when it comes to having these ERISA plans? Well, the first one is that there's a 10% early withdrawal penalty. It's growing tax deferred, and so not only we are deferring the taxes, we're deferring the calculations out to a point in time where we have no idea what that's going to be. We have to take what are called required minimum distributions, and if we don't take those distributions, there's a 50% penalty. It comes with an expensive account fees, okay, and most of us don't even know what those are, but they're built into the accounts and kind of invisible. They have limited investment options, and for most people who have qualified plans, they're going to be limited to somewhere between 7 and 24 different accounts. If you have your own plan, you might have more than that, but for most people, you're limited to how you can invest. And it's the worst money that you can pass on to your heirs. because you're passing it on with a bomb inside of it. And I always love it when a person says, well, hey, Jim, I've got $1 million inside of my 401k. And I look at them and I laugh and I say, well, do you have your after-tax statement? And they always look at me like, what's that? You see, if you think that you have $1 million in your 401k, I have news for you. When the government gets done doing their taxectomy or taking their part, you're going to find that you have a lot less than that. So that being said, you're not only deferring the taxes, but you're deferring the calculations out to a point in time where I find that most people believe they're actually going to be in a higher tax bracket. Yet, that's not what they told us. What they told us was that you should grow your money inside of a tax-deferred account because you're going to grow in money you would have otherwise paid in taxes, and in the end, you're going to have more money because you're going to be in a lower tax bracket. But most people are very surprised to know that they will end up in the same or possibly a higher tax bracket when it comes to retire, regardless of what they were told. So is it really working? You know, I talked about, you got $1 million inside of there. The government takes their portion, and you end up with $700,000 left over. It isn't quite what you thought it was going to be, yet that's what they told you it was going to be. And they get to control all the rates. Now, when we get to talking about what tax rates have been in the future, you begin to really understand what that is. So let's talk a little bit about what is qualified money. So qualified money, being qualified with who? And the answer is the government. And the government is your business partner. So they're going to allow you, quite graciously, they're going to allow you to put money in before you pay taxes and defer that tax down the road. Now, the exception to this rule would be if we were using a qualified account, which was a Roth or a Roth 401k, we would put money in after taxes, and then we would grow that money tax-free now and forever. This is also still considered to be a qualified account, yet the only thing that's really qualified about it is we still have to follow a certain set of rules, and it's growing tax-free. So IRAs, SEPs, 401ks, 401as, 403bs, 457, defined benefit plans, these all fall underneath the qualified tax-deferred accounts. Now, understand that today, inside of some of these plans like the 401k, you can get a 401 Roth, and that may be something that you consider going forward. The penalties for taking the money out prior to 59.5 is a 10% penalty. And then if you don't take the money out at 72, there's a penalty of 50% plus the taxes. Now, on the non-qualified side of the house, where we put money in taxed as we go, and keeping in mind there are really only 3 ways to grow our money: tax as you go, tax deferred, and tax free. On the non-qualified side, you are going to not be qualified with the government. You get to invest your money however you want to do it. And some of the exceptions to that might be tax as you go, might be bonds, all right? And some bonds could actually be in a tax-free environment. Then we have what are called certificates of disappointment, or CDs, stocks, bonds, mutual funds, etc. Now, talking about required minimum distributions. Under required minimum distributions, it's mandated that distributions from IRAs, 401ks, and other tax-deferred accounts, if you were born before 6/30 of 1949, your RMD date is 70.5. If you were born after that date, your new RMD date now is 72. And the interesting thing about RMDs is they can be accumulative on IRAs, but they cannot be accumulative on qualified accounts. So as in ERISA plans, 401ks, etc. So if you have a 401k, 403b, 457, defined benefit plan, any one of those plans, you must take an individual RMD out of those accounts. You can have 15 IRAs and take one RMD from all of them to take care of all the RMDs for your others. So once again, remember, under RMDs, if you have 401ks, 403bs, or 457, you have to take a distribution out of them, but your IRAs, you can take an accumulative number out of them. So how does a Roth compare to an IRA? Well, an IRA, you get to put the money in before you pay taxes inside of it. You can't take it out prior to 59.5, where there is a 10% penalty. You must start distributing it at 72 or 70.5, depending upon what your age is. There is a 50% penalty for taking it out early. It's taxed on distribution. So let's talk a little bit about Roth IRAs now. So the money that we put in to a Roth IRA or a Roth 401k, that money when we put it in is after-tax money. Now keep in mind that if you're putting money in a 403b, 457, or a 401k Roth, it's the same thing. You're putting it in after taxes, but their match is going into the tax-deferred side. So don't forget that. It's the principal that we contribute to a Roth IRA is 100% liquid from day one. But keep in mind that if you remove that money out of that Roth IRA, you must put it back within 60 days, or the only way you can put it back is to be able to put it back as a contribution for that year, and there are contribution limits on how much you can put in. It's tax-free after 5 years or 59.5, whichever is longer. Meaning that all growth that's on that account, which you cannot touch until 5 years or 59.5, whichever is longer, that growth doesn't become tax-free until that point. There are no RMDs. There are no required minimum distribution, and it passes on to our heirs tax-free. Now, some other benefits that happen inside of that Roth IRA is it's tax-free distribution. There are no RMDs. Over the age of 72, we can still contribute to the Roth IRA. The contributing IRA funds pass on tax-free to the beneficiaries. The beneficiaries can stretch that currently today out over a 10-year period of time. So here's what that means. Let's say, for example, that you have a $300,000 Roth IRA. And you pass away and your spouse passes away and the money goes on to your children. Your children must distribute that Roth IRA 100% within 10 years. Now, that doesn't mean they have to take $30,000 a year every single year over that 10 years. They could let it grow all the way up to the 10th year and then distribute it 100% at that point. This is a huge advantage over an IRA, because an IRA or a 401k is going to work the exact same way. But if they waited till the last year to take that, they would pay a considerable amount of taxes. So what typically they'll do is they'll stretch it over that 10 years, say take $30,000 the first year, $30,000 the second year, etc. And that will levelize their taxes out. But that doesn't give them the ability to keep growing that money up and make it into a large amount. Whereas the Roth, we would probably wait until the 10th year before we distributed it. There's no taxation on distribution at trust rates. And it removes the uncertainty of what future tax rates might be. Now, once we get into taxes, you understand what future tax rates will be. Then you're going to begin to realize how important it is to fire your business partner, get rid of the tax deferral, and grow your money tax-free 100% going forward. And I think probably one of the greatest things to understand about Roth IRAs and conversions is you have the ability right now to offset the losses in the market. So now what do I mean about that? So let's just say that we have an IRA that has, I don't know, IBM stock in it, or it doesn't matter, pick any stock you want. And right now it's down 40%. Well, you get to do what's called a conversion and convert that money over like for like. So it stays IBM stock as an IRA, moves over to a Roth IRA, and even though you're making a conversion, you're not locking in the losses. But now what you're doing is you're converting it at a lower value, and then as it grows back up, you're not putting that back into that tax liability going forward. Pretty phenomenal stuff. And if you haven't been doing Roth conversions right now, this is something that we should definitely be talking about. So what's the highest income taxes have ever been in the United States? If you've ever seen me, you've heard this 1,000 times. And that is the top marginal tax bracket since the inception of the temporary income tax and the establishment of the IRS in 1913 has been 94%. The average over that period of time has been 57%. We've got a national debt of $31 trillion, an unfunded deficit of $171 trillion. We're $202 trillion upside down. We have a $4.5 trillion budget, and we spend about $6 trillion every single year, or $1.5 trillion more than we bring in. It's pretty safe to say that the system is broken and that taxes have one way to go, and that's up. Okay? So if taxes are going to go up, when do you want to pay them? And the answer should be when they're at the lowest. In 2025, the Trump tax laws are going to sunset, and everybody's tax rates out there are going to go back up. So right now, taxes are on sale, and right now is a very good time for you to be considering firing your business partner inside your qualified accounts and start moving to tax-free. Keeping in mind there are three ways to grow your money. That's tax as you go, tax deferred, and tax free. Now, tax as you go, that's your cash, your savings, your CDs or certificates of disappointment, stocks, bonds, etc. Tax deferred, this is your 401k, your IRAs, 403bs, some savings bonds. And then under tax free, we have about three ways to grow our money. We're showing four here. We have muni bonds, 529 plans, Roth IRAs, and maximum funded index universal life, or even a whole life policy. Now, this isn't about that. What this really is about is, how does my qualified money work? And what my qualified money does, in most cases, unless it's a Roth, is it not only defers the taxes, but it defers the calculation out to a point in time where at this point, you probably believe the rates are going to be higher. So you really want to pay them. Now, if we're looking at tax as you go, tax deferred, tax free, which one's the best? And everybody always says, well, it's tax free. Well, that's not necessarily true. And the reason why that's not necessarily true is because if you can defer the taxes today at a high rate and then take them out later at a low rate, then you're going to win the game. Because after all, that's what they told us. They told us that we should grow our money tax deferred, grow our money we would otherwise paid in taxes, and in the end, we're going to have more money because we're going to be in a lower tax bracket. But what most people find when we sit down and do planning is that simply isn't true. You see, in order to retire, you must have one thing, which is a paycheck. And for most of you, your paychecks will come from your Social Security, pension if you're lucky enough to have one, possibly some rentals, and then it will be all of these other investments. And all of these investments are taxable, which means that your taxable income will probably not be lower. And when you hit 72 and a half or 72, you're going to have to do RMDs, and often you're in an even higher tax bracket. So really, remember, people lie, mathematics doesn't. So who should convert? Now, before we talk about converting, converting is really important and it should be done by most people, but don't lose track of the fact that we can grow our money tax-free in other areas, and often learning about those areas can be really, really important because they may be better than using a Roth IRA. So who should convert? Well, anyone who's younger and has a traditional IRA. If your children or grandchildren are out there and they're less than 40 years old, they're going to see incredible tax rates going forward. And now is the time to start moving to tax-free as fast as possible. Any beneficiary of an IRA is a trust, all right? If the beneficiary is a trust, we want to avoid those trust rates by getting over to tax-free as possible, as fast as possible. Wealthy people who don't need the money want it or will likely not use the RMDs in the distribution of their lifetime. So if you're going to be passing that money on to your heirs, converting it over to Roth makes nothing but sense. People say, well, I'll let my kids worry about that. Well, I always ask them, look, do you have a relationship with someone in the government Well, you're dying to give them your money rather than keep it for yourself or your family. And if that's not the case, then you probably should be getting that tax bomb out of that qualified account so that when you pass it on to your children, you don't have to worry about whether they're giving it all to the government. If you believe you'll be in the same or higher tax bracket in distribution years, now if you don't believe this is true, we probably should sit down and have a talk. Because chances are, if you're going to live in retirement, not exist, you probably will be. And this is not 100% true. Some people won't, and in that case, you shouldn't be converting, but we could talk about that as well. Now, if you're going to do a conversion, the best way to do a conversion is to pay the taxes with after-tax dollars. It's almost like making a contribution into a Roth IRA that you couldn't make otherwise. So how do we help people? Well, you see, you're playing a game. You're over here trying to accumulate as much money as you possibly can so that when you arrive in my world, which is distribution and preservation, the second half of the game, you don't run out of money. You need to be making a plan to live like you're going to die tomorrow and plan like you're going to live forever and make sure that you live the lifestyle you become accustomed to, adjusted for inflation, out and beyond your life expectancy, and then you pass the money on in the most tax-advantaged way that you can to your children. So we help you play that second half of the game. We're all about safety and predictability. What we do is we help people like you grow your wealth, protect and preserve their life savings, and plan for distribution of that savings in the most tax-advantaged manner while living and in death, and create streams of income that you can't outlive. So, as I said, remember to live like you're going to die tomorrow, plan like you're going to live forever, keep smiling, and I look forward to seeing you on the next one.